Welcome to Finance Deep Dive. Have you ever wondered how the giant machine of our economy is actually steered? Well, it's not just one person at the wheel. Turns out there are two powerful, and sometimes competing, forces at play.
So that brings up the big question, right? Who is in charge? It's a bit complicated. See, the power is split between two very different players, and they both have completely different toolkits. On one side, you've got the government's fiscal policy, which is all about politics. And on the other, you have the central bank's monetary policy, which is designed to be independent. Let's break them down.
All right, first up, fiscal policy. You can think of this as the government's direct, heavy-handed lever.
And who pulls this lever? We're talking about the U.S. Congress and the President. This is pure politics in action, the power of the purse, wielded by the officials we elect.
So what are their tools? They're really direct, and you feel them pretty quickly. Things like cutting your taxes to give you more money to spend, or kicking off huge infrastructure projects to create jobs. Now, the official goal is a stable, growing economy. But, and this is a big but, because it's political, the timing of these moves can sometimes be more about election cycles than pure economics. Remember those stimulus checks? Yep, that's fiscal policy in its most raw form. It's a direct injection of cash right into the system designed for an immediate impact. It's a very, very blunt instrument.
Okay, let's switch gears. If fiscal policy is a big lever, then monetary policy is more like a sensitive dial, one that's operated with a much lighter touch. And this dial isn't controlled by politicians. No sirree. It's in the hands of the central bank. You know them as the Fed, which is set up to be independent and protected from that short-term political pressure.
The Fed's tools are a lot more subtle. They're not just handing out cash. Instead, they influence how much it costs for everyone to borrow money by adjusting interest rates. And those adjustments create ripples across the entire economy. And their mission? It's famously narrow and totally laser-focused. Keep prices stable and maintain confidence in the dollar. It's a long-term game that can definitely clash with the government's shorter-term goals. So, when you hear the Fed is cutting rates, it's a huge deal. It's not just about getting a cheaper car loan. It's a signal to the whole market that money is getting cheaper, which encourages businesses to invest, expand, and hire.
Okay, we've looked at both sides of the coin. So what's the single most important difference you gotta remember here?
And here it is, all laid out. Fiscal policy is political, it's direct, and it's used by the government. Monetary policy is independent, it's indirect, and it's managed by the central bank. You could say one is a hammer and the other is a scalpel.
But here's the real question that defines economies. What happens when the government's lever and the central bank's dial are turned in opposite directions? That's when things get really interesting. If you are liking the content, don't forget to subscribe. It motivates us to keep posting.